I want to discuss with you today a hot dividend stock pick. This is a stock that I personally own in my portfolio. I have not discussed it very much here on the channel before, so I want to take this opportunity to go through this stock in great detail. I'm going to share an extensive fundamental analysis today, and the reason I'm calling this a hot stock pick right now is the stock recently fell. It's down on its earnings report. It's also down on some restructuring news, some news around the company segmenting out business units and restructuring. And so this becomes a hot stock for the dividend community because dividend investors like myself, they like to buy value. Dividend investors, we like to buy stocks when stocks are trending down. Dividend yields are going up because the higher the dividend yield, the closer that we can get to financial freedom, paying bills with dividends. And so hot stocks for dividend investors are oftentimes value stocks, stocks that are going down in price. Now, the community, a lot of people out there that I follow in the community on my Facebook group, for example, they are saying they like this stock right now and they're commenting on the stock. And it seems like a lot of folks are buying shares in this stock. Now, I'm not so sure this is a hot stock right now, and so that's actually why I want to do the analysis, and I want to share some data. I want to share some extensive balance sheet analysis as well to determine by the end of this video, hey, is this really a hot dividend stock? Is it worth buying or is it not worth buying? Now, of course, I am talking about the company Pfizer, ticker symbol PFE. This is a huge pharmaceutical company, a lot of news around this company. And so we're going to discuss Pfizer in great detail today. Now, before I get started, check out the description below. I have a link in there to a spreadsheet. You don't have to sign up for my email newsletter to receive this spreadsheet. Literally, just go to the description, click the link. You will be able to download a spreadsheet that will allow you to follow along today's analysis at home. And so I want to share with you how I look at companies, the types of things I look at. It's all there for free in my spreadsheet. And if you want to thank me, the best way you can thank me for this free analysis is literally subscribing, sharing my channel, commenting, all the stuff that you in the community are already doing. I love you guys. I thank you for the support. And in particular, I'm going to talk about Pfizer's earnings. I'm going to talk about Pfizer's restructuring. I'm going to talk about Pfizer's balance sheet. Also, by popular request, I'm going to talk about AbbVie's balance sheet and their negative shareholders' equity. And I want to talk about that in great detail because I'm getting a lot of questions about shareholders' equity. And quite frankly, I'm getting a lot of questions. Ian, I like this 10K analysis, this 10Q analysis, the annual reports, the quarterly reports. I like how you're showing me how to do fundamental analysis. And so that's part of this video today, is sharing more insights, more value on how I actually do fundamental analysis so that I can pass the knowledge around of how I'm pursuing my own journey at least. So really good dividend video today. I am telling you, this is a great one. So get ready. Let's get started. All right, so I have my laptop here and I have the spreadsheet opened, the very same one that I'm sharing with all of you. And I wrote here on the whiteboard today just the agenda. So this is the rough agenda that I'm going to follow, but it's the same agenda, the same order of events that are in the spreadsheet. And so I just want to start out and I want to talk about Pfizer at a high level. Pfizer is a dividend company. It is a stock that produces pharmaceuticals. They are probably most well known for their Viagra blockbuster drug that they have invented and produced. And they pay a dividend of basically 36 cents per quarter. And back 5 years ago in 2014, they were paying 26 cents a quarter. So the 5-year compound annual growth rate of the dividend, it's a 6.72%. That's pretty good. I like companies that not only pay a reasonable starting yield, but grow the dividend over time because that's how I get the cash flow. That's how I get cash flow that I can use to pay my bills. And I'm already using some of my cash flow to pay the bills. And so I like compound growth rates kind of somewhere in the annual range of around 7% sustainably. I think that's a really good sweet spot to be. So just something off the bat as a dividend investor I really like about Pfizer. Now, one thing I want to jump into with Pfizer is their long-term chart. So their long-term chart is really fascinating, and this is eye-opening. This is eye-opening for dividend investors. And so long-term, I'm not talking about the last 5 years. I'm not talking even about the last 10 years. Go all the way back to 2000. In the year of 2000, Pfizer was trading at $44 and change. In 2008, at its low point, it was trading at $12. Now, it's trading at $38 and change. And so the point I'm trying to illustrate here is this stock has gone nowhere in 19 years. And this is all adjusted for splits and such. I don't recall or not if they had a split during that range, to be honest, but it's all split adjusted. This stock has gone nowhere in 19 years. And so this is something to be very cognizant of this industry in particular. The industry lives and dies by the drug pipeline, and when a blockbuster drug comes out, it has a patent, and that patent expiration, it basically lasts about 20 years, and so they can enjoy these blockbuster drugs for 20 years' time. Once the patent expires, other companies can step in and they can produce generics of the same drug, and that erodes market share. And so pharmaceutical companies like Pfizer, they live and they die by their pipeline, and they always have to have a robust pipeline. People ask me like, hey, Ian, is it risky investing in AbbVie, a stock you're buying right now? Heck yes, it's risky investing in AbbVie, and I'm going to talk about that. I'm going to talk about that a little bit later in today's video. But I want to bring up this point off the bat because you'll see, and I'll talk about this later, but allocation that I have to pure play pharmaceuticals in my portfolio, it's really low. I talk about them a lot because this industry is on sale right now. I think all the stocks that I own that are pharmas, AbbVie, Pfizer, J&J, they're all on sale. So I talk about them now because I buy what's on sale, because a hot stock for me is something that's gone down and it's on sale. But don't get me wrong, the only one of those three that I have a big allocation to is J&J, and that's because it's real well diversified across pharma, medical devices, and consumer products. Whereas Pfizer and AbbVie, they're literally pharma, pure play pharma, and pure play pharma can carry high risk. And so I think that stock chart analysis is really interesting. Now, the recent high for AbbVie or for Pfizer was at $46.23. We're basically down 16% from the high. So the first thing I want to point out is I think a lot of investors are getting a little bit excited a little bit too early. It's only down 16% from the high. That is not a major correction. That is not very compelling or exciting. For me, if it were down 30 to 50% from its high, I'd start getting more interested. But for me, 16% off the high, that's just kind of normal business. That's not even really a drop in my opinion. And so I think some investors may be taking the recent correction, they may be emphasizing that correction a little bit too much. Now, just in terms of some estimates, like in terms of valuation, the consensus estimates, the analysts believe that the EPS for Pfizer, earnings per share for 2019, is going to be $2.88. If I take the current share price of $38 and change, I divide by that consensus estimate, I get a forward PE ratio of 13.48. So 13.48, that actually is a reasonable PE ratio when you look at the market. Another stock I own, 3M, forward PE on this thing, even though they're facing a lot of softness in their business, it's like an 18, 19 now. It's up there. In fact, I want to buy more 3M, but I feel like at these prices, it's kind of rebounded. It's getting a little more expensive again. I'll probably keep buying, but boy, I wish it would come back down. And I'll talk more about that. I know you guys are waiting my thoughts on 3M with the recent earnings release. I'll talk more about that, but I just had to do Pfizer because I'm getting so many questions and I have so much to say on Pfizer first. So I want to just do a comp though. So I did some comps. Pfizer is trading at 13.48 forward PE. Whereas AbbVie, it's at a 7.68. That's quite a discrepancy. So am I buying Pfizer here? No. Am I buying AbbVie? Yes. J&J is at a forward PE of 15.15. So worth mentioning, I have the choice. J&J or Pfizer. Which one will I buy? J&J is trading at the 15, Pfizer at the 13 in terms of a forward 2019 PE. Which one would I pick? J&J all day long. It's just when you look at a company like J&J, you look at a company like Pfizer, J&J, in my opinion, it's my #1 favorite stock. Pfizer is not even in my top 15. And so that is the difference. I would pick J&J all day long. And so that's why sometimes for me, just a take home for everyone, if you're looking at a certain stock, you're looking at a certain industry, if you own multiple stocks in the industry or you follow multiple stocks in the industry, try to look at the same metrics for all of them. Helps you make comparisons. Now, one thing I will mention, PE ratio. It's tough because PE ratio differs by industry. With the pharma industry, PEs, in fact, should be lower. They should be lower because it's a riskier industry. This is an industry that carries risk. We already talked about patent risk and drug risk. These patents are only 20 years. The other risk, though, is government. Government coming in saying, hey, you're charging too much for your product. And so there's a lot of risk on that side, too. And so that this is an industry, quite frankly, where the PEs should be lower, and historically they have been a little bit lower than something like a consumer non-cyclical household brand name. It just doesn't carry as much risk, and so worth noting. And so you can't say, oh, Pfizer is a PE of 13 and 3M is at an 18. Oh, Pfizer's the better buy. Not necessarily. 3M is in a completely different industry segment, completely different industry, and it may not be possible to compare those PEs. And so very important point for those following along at home and kind of thinking, is this a value or not? Is it a hot stock or not? Personally, I actually think AbbVie is kind of a hot stock here. It's trading real cheap. It carries a lot of risk, but I think the cheapness compensates for that risk. Whereas Pfizer, I don't see it being really cheap. I see it being fairly valued, maybe a little bit attractively valued, but I wouldn't start buying until it goes a little lower. So the dividend yield is a 3.71% and the payout ratio is a 50%. I like that payout ratio similar to AbbVie's payout ratio, right in that 50% range. And what this means is they pay out half of their earnings as dividends. So the other half they retain. It's a good thing because they may need that money to fund acquisitions. They may need it for research and development. They may need it just as a buffer in case hard times hit in the future. And so I think 50% payout ratio in the pharma space, pretty safe payout ratio, so not bad. All right, I want to move on. So what's going on with this thing? A lot to say. Morgan Stanley and Merrill Lynch, they downgraded it. That's always a good thing. When analysts downgrade, it's usually the time I like to buy. So I like that. And there's just some other notes. Their long-term chart shows that pharma can be a risky space, so we talked about that. I'll tell you, I think I've already touched on this, but I want to just reiterate it. I like to buy pharma when it's on deep discount because of the chart that I talked about earlier. Charts have wild swings. There's a lot of risk in the space. I will only buy when it's on deep discount. And so I'm not buying Pfizer now, but I am buying AbbVie. J&J is a different story. I put it in the comparison here, but it's really a different type of company. It's a much more diversified healthcare company. And I do think it's kind of on sale here. I might pick up a few shares of J&J this year. We'll see. At these kind of prices, I might go in and buy some more. But it's already my #1 stock. I already have a ton of allocation to it. So, okay. Everyone's asking me, Ian, what do you think about this Mylon thing? So, unfortunately, there's a lot of change going on at Pfizer, and this change, honestly, it's so much that it really muddies the waters, and sometimes it creates a headache for a dividend investor. I don't want another position. I really don't want to own this Mylon AbbVie combined, or this Mylon Pfizer combined company. Here's what's happening. Pfizer has a division called Upjohn. How do they come up with these names? I don't know. But anyways, they're going to basically spin this unit off and they're going to combine it with a company called Mylon. And so they're going to merge with their rival Mylon. And basically Mylon makes these EpiPens. And this was this huge scandal where they raised the price of EpiPens like through the roof, and it got into the political landscape. And quite frankly, it probably hurt the whole industry because now the whole U.S. government's looking into these pharma companies and seeing how they can regulate prices and such. And so it's never a good thing. But basically what Upjohn is to Pfizer right now is it's the drugs that have lost patent protection. So drugs like Viagra, Lipitor, and Celebrex. Upjohn revenues just in Q2 that was just reported, Q2 earnings they're down 7% operationally year over year. So this combined unit that they're going to have with Mylon, it's kind of decreasing in size because these, again, they don't have patent protection, and so rivals can come in, produce the same thing, and basically whoever can produce the drug for the lowest cost is going to end up winning. And so they're going to do a reverse Morris trust. What this means is if I own, as I do, I own shares of Pfizer right now. If you own shares of Pfizer, what's going to happen? In addition to owning Pfizer, you're going to now have some new company. When they spin it off, they combine it with Mylon through this reverse Morris trust, it's going to be, bam, new company. It's going to have a new name, new ticker, publicly traded. You'll own shares in Pfizer, I'll own shares in Pfizer, and then we'll own shares in the new thing. And based on what I've read, it seems like that will be a tax-free event. No taxes related to that event. I have not read up that much on it yet, though, so that's just intuitively what I'm reading so far. I need to learn more about how that will be handled, and I'm sure everyone who's a shareholder will get a ton of documentation come tax time that will tell us all exactly how to treat this thing. And so the combined company is going to have $20 billion in revenue. Pfizer shareholders will own 57% of the new company. And so something I'm concerned about with this Mylon Upjohn combined company, the thing I'm concerned is Mylon, I looked at them, they don't have much of a history of paying dividends. Way back, I think it was 2007, Mylon was paying a dividend. They haven't paid a dividend recently. And so my question becomes, okay, now I'm going to own Pfizer and this Mylon Upjohn thing, and will they pay a dividend? Will they not? So personally, what I'm going to do is I'm going to wait. I'm going to see what happens with the spinoff, with this reverse Morris trust, and I'm just going to wait. If they pay a dividend, it's a reasonable dividend, I'll probably just hold the thing. I'll probably reinvest dividends. Maybe I'll even take those dividends and pay some bills with them because it won't be strategic for me. If they spin this thing off and reverse Morris trust, no dividends with the combined new company, I'm out. I'll just sell it, and then I'll take the money, and what will I do with the money? I'll reallocate it strategically in the portfolio where it makes the most sense. And so it's a wait and see approach with me. And so ultimately, I am not that excited to own a company that basically owns a bunch of drugs that are not patent protected. And you may say, though, hey, you own AbbVie. AbbVie's a little different because, yeah, their blockbuster drug, Humira, is losing the patent protection, but they have these strategic agreements in with all the biosimilars, and they're going to receive royalty agreements and revenue from others, and they have a strong pipeline, and they have a diversified portfolio now, quite frankly, that includes Botox, if the Allergan thing goes through, that is not protected by patent. It's actually, they trademarked it, so they did it differently, which gives them foreseeably more protection into the long term. Allergan's real smart about how they protect their drugs. They do all these weird things. Anyways, I feel better about that AbbVie situation than owning literally this Mylon Upjohn thing that has no patent protection at all on anything. And so I'm not that excited about this spin-off company. And so, yeah, I'm going to wait and see what happens. I don't want to make any rash judgments. Again, I'll probably hold it if they pay a reasonable dividend and if they expect to increase the dividend over time. But no dividend, man, I'm out of that thing. And so it's tough as it challenges me a little because I like to buy and hold forever. I don't like to sell. I like Pfizer. Pfizer's been pretty good to me. We'll get to that later. But this whole separate business on its own, it's not a very compelling company to me. I'm not that excited about it. So let's talk about something else. In August 1st of 2019, actually that is today, so this will be interesting if this all goes through. My understanding is Pfizer and GlaxoSmithKline, they're doing a joint venture where Pfizer basically is selling or spinning off all of their consumer healthcare arm to GlaxoSmithKline. They're going to own 32% of this joint venture with GlaxoSmithKline, and then they're going to receive accordingly their dividends as it pertains to that joint venture. And so just something else worth noting about Pfizer. What are they trying to do here strategically? What they're trying to do is get rid of Upjohn. They don't want to worry about generics. They're getting rid of consumer. They're pushing that off to Glaxo. They're going to collect the dividends from it, but they don't want to manage it. What they're really focused on here is BioPharma, and they're looking to basically grow. They want to focus purely on that pipeline, on the blockbuster drugs, on growing the company. And they're not seeing that growth coming from generics. They're not seeing that growth coming from consumer. I think they want to be very specialized in the biopharma space. And so on that note, they acquired, or they're in process of acquiring, an $11 billion acquisition of Array BioPharmaceuticals. And so Array apparently has a very strong pipeline. I believe it was in the cancer space. And so this is strategically what Pfizer's trying to do. They're trying to really make a lot of changes at the company. Personally, I'll tell you, a lot of this kind of engineering, this financial stuff, you're seeing a lot of it at United Technologies as well, another company I own. At the end of the day, I just prefer if it all stayed one company. I think they're trying to do these things to unlock value in the stock market. But if you're a long-term investor like me, usually these short-term kind of reorgs and all this and that, it might unlock a little value, but long-term, I would say it probably doesn't do that much. And so personally, I'd rather have Pfizer stay whole. I think that would be better. I would be happier to own the stock. One of my takeaways from all of this is I'm pretty glad I took a position in AbbVie, because now I've got that diversification as well. This is a sector where it pays to have a lot of diversification, in my opinion, because there is blockbuster drug risk in terms of concentration. Okay, I want to move on. So Q2, what happened with Pfizer? And this is a long video. Hang with me because I'm getting to some really good stuff on shareholders' equity, on balance sheets, really good stuff. So we'll just keep going. I'm excited. So Q2 earnings, though, first we'll talk about that. Pfizer came in at 80 cents. They beat the estimate of 77 cents. They missed their revenues slightly. Basically, on an operational basis, not including currency fluctuations, revenue is up year over year 2%. Now, what's interesting is BioPharma revenues are up 6%. So think about this. Revenue for the company is up 2%, but BioPharma is up 6%. What this means is the other divisions, we already know Upjohn is shrinking. And so really what Pfizer's trying to do here, get rid of Upjohn. They get rid of it, but I'll still own it. And so that begs the question, do I want to hold that Upjohn Mylon thing? I don't know. We'll see what happens. If it pays a dividend, probably will. But they're getting rid of the consumer stuff. They're not really getting rid of it, but they're pushing the responsibility to Glaxo, and then they're going to collect the dividends. And so from their 32% stake, I think it was, 32%. So they're at least pushing, that won't affect their numbers. The Upjohn thing will, because they're cutting that out of the business. The Glaxo thing's different. They still own it. They own a stake in the joint venture, but they're at least pushing off operational responsibility. But really what they're trying to do is they're saying, look, BioPharma revenues are up 6% year over year for us. We want to focus on this as a company. And so, look, maybe they are making the right strategic moves. So we talked about a lot of this. In my spreadsheet, I go through some thoughts on the pharma industry. I want to just reiterate, though, a few of these. One of these is diversification is key. I like to buy cheap because it's risky. It's just a risky industry. In the spreadsheet, by the way, I have two tabs. On the second tab, I have all the balance sheets for J&J, Pfizer, AbbVie, but I also include a balance sheet from Apple. And this just goes, the reason I include Apple is I love Apple. I own shares Apple, but they just have a really sweet balance sheet. And so I want to show you what healthcare balance sheets look like versus Apple. And I want to show you what is going on with some of these balance sheets and why it actually is a little bit risky investing in this industry. And so that's why I like to diversify. That's like, quite frankly, all my healthcare allocation. It's in J&J. It's not really in AbbVie and Pfizer, but those two play a nice supporting role. So they're, and I just want to talk about that. So AbbVie is only 0.36% of my portfolio. It's basically 1/3% right now. I'll bring it up to 1% this year, actually. I'm going to go pretty heavy on it till it gets to 1%, but it'll be 1%. Pfizer right now is 1.59%. I don't remember what J&J is off the top of my head, but it was upwards of 7%. So it's my biggest holding, my most strategic holding in my portfolio. And so, but with AbbVie and Pfizer, they're real small. And I just want to reiterate this. I talk about them a lot, but they are risky, and I allocate accordingly. But I like them, and they pay me a lot of cash flow. So let's talk about a balance sheet. So in terms of balance sheet, I got this question. I did a video about AbbVie recently, and thank you everyone who watched it. It's doing really well. And one of the feedback I got is, Ian, we love what you're doing on this financial analysis. Show us more. We want to know how you look at stuff. And so that's what I want to do now. I'm going to show you how I look at balance sheets. Got this question. AbbVie is negative shareholders' equity. Let's just talk about this at a high level. What is shareholders' equity? So basically, the way a balance sheet works is it's kind of like a financial snapshot of a company. Whereas an income statement, it's talking about where things are trending for the business in terms of revenues and costs and profit. What a balance sheet shows is assets and liabilities. It's kind of like a statement, like a quick bank statement, if you will, of a company in terms of its financial solvency. And so assets includes things like cash, stocks, building, property, equipment, inventories. Liabilities includes things like debt. It includes things like short-term debt, long-term debt. And so it's important when analyzing a company to look at this, because a company has really low assets, really high liabilities. Sometimes it creates risk. And so when you take liabilities and you subtract them out of assets, that's what's called stockholders' equity, shareholders' equity. You probably also heard it called book value. And so the way this works is, let's say a company just, bam, it's gone, no more sales, nothing, out of business. Theoretically, if a company is just going to be liquidated, what are they going to do? They have all these assets, and then they have all these liabilities, all this debt. They're going to take the assets, they're going to use them to pay off all the debt, and whatever's left is what the shareholders get. That's the stockholders' equity, and aka the book value. And so a lot of people look at that, and they look at the pharma industry, and all they see is a risk, because the book values are negative. And they're more negative than you think, actually. I'm going to get to that in a minute. But I'm just going to paint this picture at a high level. A lot of people put a lot of value on book value. Look, if these companies go out of business, we got bigger problems than trying to scrap pennies on the dollars out of book value. Now, I don't think that's where the question's coming from. I think it's more coming from, Ian, these companies don't seem to be managing their money very well. They're running a negative book value. That could be a reasonable point. I think it actually is. And so it's something to be cautious of. What I'm trying to say, in other words, is the book values in this industry, they tend to be low. And I'll show you even J&J, you'd be surprised, my #1 favorite stock. When you look at the real book value, it's not very compelling or exciting the way like a bank stock would be. Now, I'll tell you, if I'm analyzing other industries like banks or like insurance companies, that's different. Assets have to be greater than liabilities, or the bank would be out of business. It would just be insolvent. Things can be a little bit different with a drug company for two reasons. One, they're generating all this cash, but they're just paying it out to shareholders. Yeah, they could have a higher book value. All they have to do is stop paying the dividend, hoard the cash, assets go through the roof, liabilities stay the same. Bam, they've got a positive book value, but they don't do that. Most of the stocks I own, they pay out heavy, heavy dividends, and so that's why book value is negative. Another reason book values are negative is, look, interest rates are really low. They're probably not going up anytime soon. And I think it's going to be really hard for the Federal Reserve to raise interest rates just because of the amount of government debt, corporate debt. If they do raise rates, they're going to create a lot of pressure on our economy. And look, they just lowered rates. And so what has happened because of these low rates is these companies they've taken on debt, they've used it to push their businesses forward, to make acquisitions, and it's true, a lot of them have a lot of debt. It's a risky thing. But the way I look at it now is they're taking advantage of a moment in time when the interest rates are low. And if they are smart, they will now start paying down their debt, and they will reduce their liabilities, and by reducing liabilities, their book value will look better over time. And so that's the other way I look at it. But there's no doubt about it. right now the book values in this industry, they're not very exciting, even for J&J. And so I want to just go through actually Pfizer first. So in terms of assets, they have 159 billion and change. Now, of those assets though, I only look at 70.8 billion as real. And so you'll see this in my spreadsheet. Why? They have something called goodwill, and they also have intangible assets. Honestly, I don't place a lot of value on goodwill. Look, if Pfizer is going to go out of business and we're looking at liquidating assets, are they going to get any value for goodwill? I don't think so. Or these intangible assets that they're carrying at 35 billion? Probably not. So I look at real assets. Real assets to me, cash equivalents, stocks, ownership in other businesses, things like that. Real assets for Pfizer right now are 70.8 billion. Now the liabilities are 95.6 billion. And so in terms of shareholders' equity, if you believe that the goodwill and the intangible assets have value, they have a book value at Pfizer and it looks good. It's 64 billion. But if you look at the real equity, the real shareholders' equity, which the way I calculate is I take assets, I subtract out goodwill, I subtract out intangible assets, I take that, and then I subtract out liabilities, the real book value that I get for this thing, or shareholders' equity, is a negative 25 billion. And so even for Pfizer, I'm in real terms, I'm seeing a negative book value. And so that's something to be cognizant of. Why are the PEs lower in this industry? Why are people cautious of this industry? Book values are negative. It is a more risky industry. There's no way to sugarcoat it, but sometimes taking calculated risk provides rewards for investors. And you'll see it's rewarded me handsomely on Pfizer because I bought back when it was $20. And so I'll share more about that later. Okay, AbbVie. AbbVie's assets are 59 billion and their liabilities are 67.8 billion. So they have negative equity of negative 8 billion, even including goodwill and intangible assets. If I take their assets and I subtract out goodwill and intangible assets, their real equity is a negative 52 billion. And so, and this is even before financing of the big acquisition they're making, Allergan. And so AbbVie is in a position, it is true. People ask me, Ian, what do you think about that negative equity? Well, two things. One, AbbVie, if they go out of business, there's going to be no equity for us shareholders. We get nothing. And I'm not really worried about that because, look, they go out of business, I got bigger problems. But two, what it tells me is they're being aggressive, they're taking advantage of low interest rates, they're taking on a lot of debt, they're doing that to make acquisitions, and they've already been doing that, they're being very aggressive, but they're just generating so much cash as well. And so I'm getting my dividend, they're paying the cash, interest rates are low, and so there's a lot of things I'm weighing, a lot of different thoughts I'm weighing at the same time. For me, I think it's all in the valuation. We know, look, you don't get a PE of 7 with no risk. The reason AbbVie's PE is at 7 is because there's risk. The reason Pfizer's PE is at a 13 is because there's less risk than with AbbVie. It's natural, it makes sense. And so, am I okay? What would I rather buy here? I'd rather buy AbbVie because I'm in a risk-taking moment. I know my allocation. That's where I'm my persona. I like seeking that risk because I'm going to be rewarded for it. Starting yield on AbbVie is twice that of, or around twice of what Pfizer's is. And so I'm willing to take on the risk. And we've talked about this at length in the last video, what I think is good and promising about AbbVie as well. So you guys can check that out. I'll link in the description. Now let's look at J&J. J&J's assets, this is going to shock you, by the way. My favorite stock. Assets, 153 billion, but they carry a lot of goodwill and intangible, 30 billion goodwill, 48 billion intangible assets. Their real assets are, only 75 billion. So of the 152 billion, only 75, in my opinion, are real assets, like assets right now, like cash equivalents that could actually be used for something. And you know what's funny? I'm not even subtracting out inventories, but I don't think these businesses carry a lot of inventory. I mean, cost of producing these pills is pretty low. And so anyways, moving on, liabilities at J&J are 93 billion. So J&J's equity is 59.7 billion. but the real equity is a negative 18 billion. So you'll see this in the analysis. Basically what I'm pointing out here, and this actually, I liked this. When I look head to head, all three, AbbVie, Pfizer, J&J. AbbVie, from a balance sheet perspective, clear loser. But that's the reason it's trading at a PE of 7. J&J and Pfizer, it's interesting, their balance sheets are not so dissimilar. And so it's a reality check for me, and this is why I do these comparisons. This is why you should at home. It was just kind of a take home for me. It's like, look, J&J is my favorite stock. I love it. There's many reasons I think they're safer and better than Pfizer because of their diversified footprint, consumer, devices, pharma. But put that aside, just look head-to-head balance sheet. Pfizer's at a PE of 13, J&J at 15, so J&J is getting a premium, but their balance sheets are pretty similar from a shareholders' equity standpoint and from a real assets standpoint, and so real assets minus liabilities standpoint. And so that was just eye-opening. If you had asked me before I did this analysis, whose balance sheet is better, I would have said, oh yeah, J&J significantly better than Pfizer. But this is why you have to look at the numbers. You have to do the fundamental analysis because it'll show you things that you might have not known otherwise. And so this was kind of a plus in my book for Pfizer. I'm like, yeah, Pfizer, you're actually doing pretty well. You're a good company. And so they're a better company than I thought they were, which is cool. And so let's see. I'm not too strict on shareholders' equity. So this is just something I want to reiterate again. A lot of investors are. That's okay. You need to go home and determine for dividend investing, what are your triggers? And you need to understand by industry, for certain industries, what's your checklist? What do you want to see? If you want to see positive shareholders' equity, that's important to you, put it on your list. For me, it's really important for bank stocks, insurance companies. It is not really important for pharma. It's certainly not important for household name stocks like consumer non-cyclical. Don't care about book value. They generate cash. They give me the cash. That's why the assets are low. There is a reality check with all of this, and this is a problem in corporate America and global corporations now too. They're taking on too much debt, and that surfaces through these balance sheets. It's a risk that not only dividend investors run, but any investor runs. Investing in stock market these days, most companies are taking on too much debt, in my humble opinion. It surfaces through this equity, this shareholders' equity. So that is a valid concern, and investing in stocks is not for everyone. Investing carries risk. Really important to paint that point because a lot of people will not say that. I cannot say it enough. What I'm doing, my journey, it carries a lot of risk, even though my strategy is a relatively conservative strategy compared to some others like tech stocks or day trading. So penny stocks, it's relatively conservative compared to those, but it still carries a lot of risk. And so my history with Pfizer, I bought this thing originally in 2012. I paid $21 a share. So I paid 21. What is it trading at now? I'm going to scroll to the top here. We're at 38. And so I'm up quite a bit, nearly double. And so I bought most of my shares, a lot of my shares between $21 and $30. So am I buying at 38? PE of 13? No, I'm buying AbbVie now. And I'm not going crazy on AbbVie. Again, I'm going to bring it up to 1% of my portfolio. 1%, that's it. And so my yield on cost of Pfizer on my first tranche at $21 is a 6.86%. So almost 7% yield on cost. And so the take home here is, or takeaway here is that, again, that's simple yield on cost. That doesn't include reinvested dividends. And so investing in dividend stocks for the long term, even risky ones like pharma companies, if you buy at the right time, you buy, for example, when Pfizer's at 21, deep discount, and you hold, you take calculated risks, you know these pharma companies are risky, but they also got a lot of cash coming in, margins are good, payout ratios are reasonable. Hey, there's opportunity. That's I'm living proof here without even including reinvested dividends. First tranche of Pfizer, I'm yielding 6.86%, and that's only from 2012. That's not that long ago, and so just worth pointing out there. But This stock, which I think is getting hot in the industry right now, for me, it's not a hot stock. And so that's the conclusion of today's video. It's not a hot stock pick for me, but I'm not buying any more Pfizer at this time. But I'd be curious, what are you doing? Are you guys buying Pfizer? Look, I own Pfizer. I love it. And so share in the community. I love the comments, the feedback, the discussion. We're a thriving community, dividend investing for everyone. We're dividend investors supporting one another, sharing all of our journeys here on this channel and also on my Facebook group and throughout social media, PPCE and social media, Twitter, Instagram, all that good stuff. And so I'd love to hear what you think. And this is my perspective on AbbVie, Pfizer, J&J, the landscape right now. And it just gives you, look, I do more financial analysis than this, but it gives you a hint of how I look at balance sheets. And I hope that's the biggest takeaway from today's video. I hope you all go home with a new way, a different way to look at balance sheets. And if you want to find these balance sheets, they're all in the second tab of the Excel file that I shared today in the description below. Just click it. You can download the Excel file. Don't even have to enter your email, nothing. And I just love you guys. Just want to get the content out there, all the good stuff. And so, yeah, that's the video for today. I thank you. I thank you for that request. This is popular request from folks in the community. Keep them coming. I will get through the requests one by one. In terms of full disclosure, I am long. I own the stocks mentioned today. I am long 3M, ticker symbol MMM, United Technologies, ticker symbol UTX, Pfizer, ticker symbol PFE, Apple, ticker symbol AAPL, Johnson Johnson, ticker symbol J&J, and AbbVie, ticker symbol ABBV. I own those ones in my personal dividend stock portfolio. In terms of a friendly disclaimer, today's video is not investment advice. It's just for your fun and entertainment. I'm not a licensed investment advisor, just sharing my personal journey here on YouTube for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. If you want to support my channel, I'm sharing my best content here on YouTube for free. I would so appreciate you guys subscribing, hitting the notification bell, support on social media, comments, likes. Just take a moment to click that subscribe button. It is one of the best things you can do to thank me for producing this content here on YouTube. All right, everyone. I wish you a wonderful day. I'll see you in the next video.